Hello, everybody. This is the Physics of Bitcoin show, and we are having. Uh, I'm having here with me Stephen. He just left. um, okay. So anyway, there is pretty nice Bitcoin action right now. We are close to 108, which is nice. We had very good moves in the last few days. I guess, I don't know, people felt a little bit better after Israel and Iran maybe are trying to do peace. I don't know. But anyway, so this is the Physics of Bitcoin show, and we usually explain a little bit the purpose of the show. Me and Stephen are physicists. We have, we study from the field of astrophysics, and then we explore other interesting professional fields. I worked in neuroscience. Stephen work in different applications, particularly in the world of computing. And the good thing about that is that we had the chance of applying this concept from physics to new fields and see how efficacious and powerful this framework of looking at the world is. Physics really it's the queen of sciences because it tries to go to the foundations, to the basic principle. And when we are thinking about something, we are starting from the principles behind whatever we are studying, and then we build up. We want to understand not just how, but also why. Um, you know, but Galileo say you need to understand how before you ask why. But yeah, once you have enough information about how, then you go deeper in trying to find out why. And both in our exploration of different topics, different things that were interesting to us, we discovered Bitcoin, and then we started to apply. Of course, everybody comes in from different life experience, different angles, and being scientists, being physicists, we approach Bitcoin from a more scientific point of view, and we kind of at different stages, but it doesn't matter. Basically, kind of independently, we found Bitcoin. We found that this framework, that is the power law, the fact that Bitcoin has this scaling behavior over time, and right now it's one of our foundations in understanding Bitcoin. But it's not the only one. We are also using different tools to explore. The main goal is to look at Bitcoin as a scientific phenomena that can study with empirical information like data, but also mathematical tools, analogy from physics, and so on. We are also in the process of creating an institute. It's going to be called the Bitcoin Scientific Research Institute. We are creating a board now. We are discussing about the manifesto. We are working on this manifesto. I posted an early version, but we will have a more clean one in the next few days, and then we will share with the community. Anyway, do you want to add anything else, Stephen?
No, we can have the debate about whether physics is the queen of sciences or the king of sciences. Maybe we'll leave that discussion for later, but the god above that is mathematics. And so we use that to do our analyses. So I'm going to show some a different approach that couples some physical ideas and some mathematical concepts today. And thanks for that intro.
Very good.
And thanks for people for joining today.
Okay, so Stephen, if you want to go ahead and share your agenda.
Okay, I think this is our 25th show. So we've got 25 on June 25th in 2025. We've got some numerical consistency going on there.
Maybe we should switch and go to numerology instead of.
Yes. 25 cubed. Um, and people who know the song, an old song, the year 2525, we're 500 years short of that. But this
there
is
is this funny scene in one of my favorite Italian movies. I don't know if you ever saw it. It's called Cinema Paradiso. And
oh
they
yes, of
show,
course.
yeah, there is that scene where the teacher, right? This was like a kind of antiquate school, like in the 40s, I don't know. And there is this child that is a little bit, behind, and the teacher asks the child, "What is 5 times 5?" And he doesn't know how to answer. And then the protagonist, that eventually will be a movie director, a famous movie director in the movie, is a child, right? He's trying to help his schoolmate, and he shows the book where there is 5 times 5 equal 25, and there is a picture of Christmas, right? There is like a Christmas tree or whatever. And so he shows to the child, the teacher is not seeing, because kind of like a hint, to tell him, look, it's 25. And the child answer, 5 times 5 is Christmas. That was his answer.
Okay.
5 times 5.
Well, I have my own story. When my older son was 4 years old, I asked him, kind of out of the blue, I don't quite know why. I asked him, he was 4. I asked him, what's the square root of 25? And he said 5. And
Wow.
so from there,
it's your son.
I
It's your
started to
son.
realize that he does have pretty good math intuition. So we started studying the square roots with him from a young age. This image that I have here is brand new, just newly released. It's from an observatory that's based in Chile, but it's an American observatory known as the Vera C. Rubin Observatory. She was one of the key researchers in the topic of dark matter. And it's an image of a portion of the Virgo cluster. It's located about 50 million light years or so away, and it's receding away from us. I don't know exactly, like 1,000 kilometers per second as part of the general expansion of the universe. We're in our own little cluster called the local group. We're not in this one, but we're kind of at the edge of this one. And there's a super cluster that we're collectively part of, but we're not gravitationally bound. But it has these two beautiful spirals, not unlike our own Milky Way that you can see, and in the lower right. And then you look in the upper right, those 3 galaxies all appear to be merging. There's a lot of merger of galaxies that goes on in their long histories. So, the fundamental forces are all at work here: gravity, electromagnetism. We see the light. The light comes from nuclear physics, in the cores of the stars. There's X-ray emission from this cluster too that we don't see in this photo, and there's probably dark matter dominating the whole thing. Anyway, onto the agenda. I want to talk about approximate entropy today. I don't know. I kind of stumbled across this concept in the last couple of weeks. I wondered, well, what does this mean if you apply it to Bitcoin's history? So I started doing that and did a literature review as well to see if other people had looked at that with respect to Bitcoin. We have done the work on the Hurst exponent, and so I wanted to contrast how that compares or differs from the Hurst exponent as a tool for analysis. And then, of course, as we like to do, we break it down between the power law core and the bubble and see how it behaves in those 2 domains. We look at it with respect to how price changes, how the day-to-day returns change, or in this case, I used weekly data, and then also the residuals with respect to what we know is the underlying behavior of the power law. And for all this, we use the logs because there's such large dynamic range, right? So approximate entropy is something that comes out of information theory, and I'll show how the calculation, what the theory is behind that. But we also want to look at how it's developed over time. So some very interesting results emerged as to how it looks over time. And then I'll close with a brief section on the question about the Bitcoin treasury companies. How is the yield diminishing? I saw a post from someone that said, G, it's falling like a power law, basically like a reciprocal function inverse first power roughly. So we'll take a look at that at the close. Okay, approximate entropy is a fairly new technique. It dates from the beginning of the 1990s. A researcher known as Steve Pincus. It's actually been used in physiology. It's useful for when you have short time series. And if you're looking at heart rate variability, you don't want to get too much data. You want to treat the patient, right? So you don't want to just gather data. And so how do you characterize complexity and the regularity of noisy, relatively short time series? But it's also been used in finance because of the nature of financial time series as well. And the question it asks is, how close is one?
Will you show in or the comparison with the normal idea of entropy and at the point how they compare?
I couldn't hear.
Will you discuss how it compares with normal entropy with the usual notion of entropy by Shannon?
Yeah, well, it comes out of information theory. Mm-hmm. And you can sort of see how it compares when you look at the equations here that we'll do in just a moment. It's basically asking how close is one vector to another relative to the standard deviation of the series. And these vectors are very, very short. They're like length 2, length 3, or length 4. So what it does is it looks at the series, it breaks it into all these short vectors of length 2 and 3 and 4. And so you've got all of these short vector patterns of length m. You've got many, many vectors, and then you ask how close are they to each other? And you ask how close are they in percentage terms of the standard deviation? So in this box with the equations, it says how many vectors are there such that the distance is less than r, where r is some percentage of the standard deviation. And they often use like 20%, 0.2. And then you take those and you take the log of those and do a sum. Now, taking the log is where the parallel with the entropy equation comes in, right? Because that usually goes as a probability times the log of a probability, right? Mm-hmm. So you're taking the average of the log probabilities across, the full set of data. I mean, if you had 100 data, then you'd have like 99 vectors of length 2, right? And then you fold them through this process. And then to get the approximate entropy, what you do is you compare the difference between order m and then order m plus 1. And so that would be the difference between vectors of 2 and vectors of 3, for example, or vectors of 3 and vectors of 4. And what you find is you go to the higher order, this quantity of the average log probability decreases. So it's the difference of those that's the logarithmic likelihood that a run of pattern will still be close, in standard deviation terms, or fraction of a standard deviation term when you go to the next order. So if you get a low value of this approximate entropy, as it's been named, which does indeed derive from, Shannon's information theory, but has a twist on it. If it's low, then you've got something that's regular. And if it's high, you have complexity and irregular behavior. I did a literature review. I found 10 papers. Out of these, only 2 were kind of relatively interesting and relevant to what we're asking here. It was interesting. A lot of them seemed motivated by COVID-19. And a number of them were published at the National Institute of Health site. So I don't know why exactly. There must have been some funding that was available.
Yes.
Right?
I found a lot of papers on, power laws in the spread of COVID, for example.
So the impact of COVID-19 on the dynamics of cryptocurrency markets, stability and irregularity of cryptocurrency markets during COVID-19. It's not too relevant for our purposes about that, but here's one. This is the 6th paper, Liu and Chen. It was done only a couple of years ago. Highlighted AppN, which is approximate entropy, ability to signal turmoil and transitions linking to macroeconomic uncertainty. So the plot here, the figure is from that paper, and it shows the order of M2 and the order of M3, and you can see that the orange curve is always below the blue curve. As you crank the order up, it does go down, but they're both significant, and they both have, some fair amount of variability, with the M equals 2 running between about 0.5 and 0.8, which is pretty noisy or irregular, right? And then the M equals 3 running between about 0.2 up to about 0.6. So it's showing irregularity, and you look where COVID was, you're kind of in the middle of the plot. I don't know. And yeah, that's the one, Lewin Chen, Sustainable Finance, Bitcoin, and Fractal Entropy Analysis. So they used 8 years of daily log returns. And that's just, the percentage change, but in log terms. There was one other paper, the particular results weren't that interesting, but in general, they said that they showed that Bitcoin combines high standard deviation and low approximate entropy. So that's interesting, right? Those are two things that are sort of in conflict with each other, but that's what we know Bitcoin to be. It has high overall volatility, but low approximate entropy. And as we'll see, particularly in the power law core, relative to gold and the S&P 500. And just a reminder of the Hurst exponent and comparison. This is what we had found for the Hurst exponent. It stays very high. It's a signal that shows us there's a lot of order and persistence of the alpha, of the outperformance of Bitcoin. That hasn't gone away.
So for maybe, for the people that are not super familiar with some of the basics, entropy, right, even at a popular level, is associated with some level of disorder, right? Something that has a high entropy means disorderly behavior, right? So
Let's clarify. Clarify that. It also is associated with high information. In other words, if you have a very simple system at a uniform temperature, and what the component molecules are, they're, N2 and O2, right? Like in our atmosphere, and the temperature and the density or the pressure, you can characterize the air in the room with just a few values, right? And with the power law, we characterize the long-term behavior with only 2 parameters, a scaling factor and a power law index.
Right.
So that's low information. That's low entropy. We don't, there's not a lot of surprising information there. Entropy is high when you get surprises. So bubbles growing and collapsing, those are surprises. And those require much more detailed analysis to understand, more parameters. So for example, the log periodic power law has 7 parameters, and you need something with a lot of parameters to characterize the growth of bubbles and their collapse.
Yeah, this is why I did an interview a few days ago, and somebody said, "Oh, there is a critic of yours." They say, "It's some guy called Morris."
Yeah.
I don't know. I will not go in the personal details, but to say, "Oh, you may overfit the power law." When you have something like one parameter, I always say actually the power law has one parameter, because actually the scaling, it's it depends. You can have a scaling at the bottom, for the support. You can have it a little bit. It's really one parameter with slope, right? That is really the essential. So it's basically impossible to overfit something that has one parameter. It's impossible. Right. There is nothing to overfit there. So it's somebody that doesn't understand the math. You can overfit something that has a lot of parameters. But yes.
Yeah. Whether you do it in gold and dollars, euro, or yen, the scaling factor is different from those, right? Yeah. But the parameter is essentially the same against all those. So that's the one key parameter. So relative to this Hurst exponent method, a low approximate entropy aligns with a high value of H, and we have very high values of H. It's about also more local in time frame, local irregularity. How hard can you predict? How hard is it to predict the next value? Whereas Hurst is more about long-term global memory, long-term trend persistence. So they may agree, white noise, for example, would have high approximate entropy and H would be 0.5. When H is low, you have mean reversion, and that's what Standard & Poor's, SPY and stock market does. Okay, here are the results for the whole suite of data, 15 years of weekly data. And I did, 3 analyses, one for log price, one for the log return, and then one for the residuals after removing the power law.
Mm-hmm.
And we get a very low number of 0.07 using the log price. So that says, not surprisingly, strong trend, highly predictable. We get a high value when you use the log return because it's local noise.
Yeah,
Highly irregular, volatility driven.
I want to say, when you take returns, you're taking the differences, right?
Yes.
And so it's almost like a way of detrending in a way. And so in that case, you will emphasize the noise more than the trend.
Correct. These are just the week-to-week percentage returns, basically.
Yeah.
With short vectors. So they're just from one week to the next.
Right. Now, if you're looking at a long period of time for the returns, even that has a trend. But yeah.
So that's the next one, which is the residuals, where we take the power law, and then you see it drops dramatically. It falls from 1.4 to 0.5. So that says we've got moderately structured noise, and we may even be seeing cycles. And at least you're seeing, regimes where it goes from one regime to another. So low app-in for trend, high for returns, intermediate for residuals is a signature of nonlinear financial system with long-term structural growth, chaotic volatility in the short term, and an intermediate structure in the fluctuations, which might be due to cycles or might be due to regime changes. Certainly, we have seen these rather sharp changes between the power law core and the bubble regimes. Okay, so then I broke out by core and bubble and say, let's just do on each of those. And then the core, again, it's 0.07, not surprising. And the bubble is also quite a low number. It's 0.13. Of course, it's higher, but it's, so it's got some complexity. So, of course, Bitcoin behaves in a more structured and deterministic way when it's priced at or below its fair value. And if you go to the next higher order, M of 3, you get about the same results for log. This is all for log prices. And then I went to the higher order for those 3 series with M equals 3, and the numbers should be smaller, and they are. So the log 10 prices was still very low, similar. Log 10 returns dropped roughly in half to 0.74, and the power law residuals came down a lot to 0.47. This is formally called the embedding dimension of M equals 3. So it means a bunch of vectors of length 3, comparing them one to the next, seeing how far apart they are. Bitcoin's long-term price path is almost deterministic, while the weekly returns and trend residuals contain moderate structure, suggesting nonlinear dynamics, not just randomness. Okay, now let's look at how this develops with time, and it gets quite interesting. So here, the blue color is the price, the approximate entry history for the price, and I used a 2-year filter, a 100-week rolling approximate entry for each of these series. The orange is the log 10 return, and the green is the residuals, power law detrended. People who look at also I have the price there, is the soft gray line. So the first kind of analysis by chat was spikes have unsustainable price action. Entropy is not just volatility, it reflects a pattern of unpredictability. a nonlinear regime switching system between low entropy trend following and high entropy chaos. So that's the kind of very high level. But the next thing, if you're observant, is you might notice that some things are lining up with price peaks. And that will become clearer in the next chart. And this is for the case of the shortest vectors, m equals 2, 2-year rolling average, and R is 0.2 means 20% standard deviation. That's what you're counting. And that's typical value that's used in these analyses. Now let's check when the peaks and the minimum happen, and then the price peak. So if we look at 2013, 2014, the red dash line is the price peak for that 2013 bubble.
Mm-hmm.
And you can see that for each of the price minimum or the maximum for the log 10 return entropy and the maximum for the residuals entropy, that they're lining up pretty nicely.
So two things. One, the value is low, right?
Log, they're all logs.
Yeah. And but at the peak, the value tends to be small, right?
These are the approximate entropy for all of these, and for log 10 price, it's small.
Yeah. What is the interpretation of that? Why have a peak? We will have a...
Well, remember, these are 2-year rolling.
Right. Okay. So it's basically looking back 2 years, right?
Yes.
Probably because we actually went up, right? Went up over that period in a pretty steady way, right?
Right.
Is that a possible interpretation of what is going on?
I think it's seeing. This is the 2 years prior, right? So it's the 104-week rolling for the 2 years prior.
There was momentum in the price. There was a directionality because there was momentum, right?
It's seeing the momentum of the prior 2 years price.
Right. Yeah.
Okay, so they line up well for the end of 2013 bubble. They line up pretty well for the end of 2017 bubble. They line up well for the 2021, which was a double bubble. And even for the little kind of small bubble we had with a peak at the end of 2024, they line up.
Yeah.
You know, so the way you want to look at this is look at the blue and the orange in particular. The green's pretty noisy. It's kind of hard to, a lot of structure in there, a little harder to pick out. But you find that in each case, the orange, which is the log 10 return approximate entropy, is leading price. That peak occurs first. And the log 10 price approximate entropy is lagging the price peak and confirming it, if you will. And this shows how much I cleaned it up by removing the green line and also showing the peaks a little more clearly with these dashed lines for the blue and the orange for the price and the return. And you can see how close those are to the red dashed lines, which are the price peaks. You know, in general terms, they're pretty close.
Mm-hmm.
The orange lead is longer. And so if we compare the approximate entropy minimum in the price and the log price, it lags by about up to 12 weeks.
So the fact that maybe the lowest points, right, that are associated with the peak, this is for the blue line, there seems there is a general trend, right, that we're actually going to higher and higher entropies. How will you interpret that?
Oh, yeah. I don't know. I mean, I noticed it, but I don't have an interpretation yet.
Could it be that the cycles are less pronounced?
It may be related to the weakening of the cycles.
Yeah.
Strangely enough. but I'm not sure that that makes sense.
Okay. Yeah.
And then the log 10 return lead is around 40 weeks in most cases. Now, if you look at the most recent one, our max for the orange line, the log 10 return, was in April. So 40 weeks after that was a peak at the beginning of December, which was our last price peak. Hopefully we'll break through that, and in fact, we did set another price.
Yeah, this cycle is so anomalous. This is another piece of evidence that this cycle doesn't behave like the others.
So was that the bubble is a question, or is this the first of a double bubble? That's an open question.
Yeah, exactly.
And then the blue minimum in this case was in March, beginning of March this year, which interestingly was around the time of the maximum tariff uncertainty. Now, this is the higher order, M equals 3. And again, you see things are lining up similarly. I've used these kind of ovals to mark where there's the overlap. But qualitatively similar, but the values are lower. It highlights deeper, more structured behavior. You now see distinct low entropy pockets for trend-driven runs and market corrections. So here's one point, is that the trend-driven run will give you low entropy, right? So that's part of what we're seeing there. And here are the timing.
What M3 means that you're looking at 3 data points instead of
yeah, it's actually looking at 3 and 4. So it's taking vectors of 3, computing that 5 parameter, which is a sum of the log of the probabilities of being within a fraction of the standard deviation. And then it's doing it the next higher, which is M of 4, and it's taking the difference. That's the formula. So M of 3 is the base, and then M plus 1 is the higher embedding, and it compares those two to calculate the entropy. And then this shows the timings of where the peaks with these dashed lines again. And qualitatively similar, a little bit different in details. But the price normally the approximate entropy of the log 10 price normally lags the price peak by up to 16 weeks, but in one case, we show it preceding, which is actually the latest one. And then the orange peak, the log 10 returns, those precede by roughly 20 weeks.
So it almost reminds me the relationship between the blue and the orange, like sine and cosine, right? Like
yes,
if you have a position and velocity, right? We are going to be in an harmonic oscillator. We are going to be out of phase by 90 degrees, right? And
correct.
This seems to be the same here, right?
Correct.
There is a peak for the orange when there is a low for the blue. Because the return is almost like the velocity of the price, right?
Right. So I guess the takeaway is that there's some predictability here. And that, it works at M equal 2, it works at M equals 3. I'm not sure if one is better than the other, and they're roughly similar.
Have you tried to make a very long moving average, like at 4 years, for example, or whatever, and see how that looks like?
Extremely long vector?
No, moving average. To maybe to kind of de-emphasize the cycle. I'm curious to see.
Yeah, I looked at the 4-year and it was a mess.
It was a mess. Okay.
Yeah.
Probably because it's still a bunch of small little vectors, right? So that don't have. But what will it work if we make them big, like like a a bunch of vectors. I'm trying to understand how these quantity grows without the bubbles, like if you don't have the bubbles,
Right.
or maybe you can smooth first, like maybe you can take an average of a price, right, a moving average of price over 4 years, and then do these calculations over that quantity.
Yeah.
I want to see if entropy, the general entropy, this quantity of entropy grows with time over the smoothed behavior. I will play with it to myself. It's very interesting. Yeah.
It's an interesting technique. Okay, so a reminder that the differentiation between the core and the bubbles is dropping. The core has consistently had standard deviations. These are average with a rolling 4-year filter, but around 20%, whereas the bubble standard deviation has dropped from 100% to below 40%. So they're converging. And then it's done that with roughly a reciprocal relationship. So, it opens the question as to whether the mini bubble that we saw at the end of last year was it. Now, a few slides on Bitcoin treasury companies. I saw this from, what's the name of it? Microstrategist.com. This idea about how does the yield fall off. So first, there are now over 100 companies that have adopted Bitcoin treasury strategies. Michael Saylor's way off the chart. So in this fit, I did a power law fit to the BTC holdings of the top 99 companies, except for strategy, because it is really way off the chart. And so the question is, do you have something? This is a rank. So it's, the size of the holdings relative to the rank. And you're asking if it adheres to something like a Zipf's law, which would have a power law of -1. And it does for the first 15 or 16, for the top of the list, if you exclude master. And then all the rest are way behind, but they've also entered the game fairly recently. So it kind of shows what they need to try to do. What happens is that as networks mature, they move towards Zipf's law.
Yeah.
I'm reading an interesting paper now about cities and how they do that. And the network has to mature. Things have to be able to kind of move around. And since they're very new, it's not a mature network.
They don't behave yet as real networks. Yeah.
So we'll see how they develop over time.
Very interesting.
But now on to the yield. I mean, the one on the left just shows the stacking race. This is from MicroStrategist. And, we see the top ones being Strategy and Mara, 21, which just got started, Similar and Congo. And the one that's really moving now is the Japanese one, Metaplanet, the orange one.
Very steep.
Yeah. So, but then they said, well, it looks like the Bitcoin yield is falling as a power law. So they took essentially these curves and then converted them into yield per day and then normalized them to whenever the particular company started their Bitcoin treasury strategy. So it's days from the start of Bitcoin strategy for that particular company, And of course, the long purple one is strategy, and it's the only one that exceeds 1,000 days or 3 years. It's 4 years or so now, almost 5. And so, they've got more data early on for the high yields and less later on because there just aren't that many companies that are even over 1 year, right? But they took all this, what's on this graph, and then they tried to compress it all into a single power law by averaging the yield across the data set that they had. And they said, it's falling as x to the minus 0.95. that is the days from the start of the Bitcoin strategy for each particular company timed to the roughly, -1, roughly the reciprocal of the age. So they said it's falling like this. And just to calibrate things for you, if you're at 0.1% per day, that's 44% per annum Bitcoin yield. And if you're at 0.01%, that's 3.7% per annum. So, we care a lot about the difference between those two, right? Staying above at 0.1 is really nice, and dropping to 0.01 is okay, but less interesting. So I said, well, gosh, what happens if you then take this equation and then turn it into what kind of stack would you accumulate? If you follow that dotted line, how would your stack grow with time? And I found that if you started with 3 coins at 10 days, you could get to 6 at 100 days, you could get to 10 at 1,000 days, but it gets really hard. It takes you 30 years to get to 14, and it takes you 300 years to get to 19. So this shows, the Red Queen race that's going on, how they just really have to run very fast to try to get ahead of each other and get Bitcoin from the market at all. And then the next slide says, well, this does not apply to strategy yet. This is Bitcoin's annual yield for strategy from the beginning. And it was 200%. It dropped all the way down to a small number, less than 10%, until they figured out how to raise money from the market, particularly with preferred stocks and so forth, so that they wouldn't have dilution. And so actually they've been able to increase the annual ever since then. They had a really strong quarter at the end of last year, with just that one quarter had 77%. If you take the first half, strategy's at 19%. So if somehow they're able to maintain that and not to have decline, unlike the previous slide that says it falls inversely with time, then they could get to 2.1 million in 3.6 years, which Saylor would like to do. So my takeaway is that the lead horse gets the most capital, because the reason they're able to do that is because the market is willing to give them capital for their preferred shares of various types. And if they need to do an ATM, the market's with equity, the market's willing to give them capital for that. And the market's not going to give capital to all of these others in anywhere like equal amounts. And so they're more likely to suffer decline. So that's it for my slides.
Fantastic. So you think it's not a good idea to invest in all the other treasury companies?
I think you have to watch them. I think they may be good, 1-year trades, right? I personally own some similar and some Metaplanet. I would stick to the leads, the highest quality ones that look like they're a little bit underpriced and that have the largest stacks and the highest yields, but not so overpriced relative to their yield.
Yeah. Okay. So I'm going to discuss my section of things. All right. So let me go to the right slide. So first I will discuss this. And again, whenever we talk about somebody else post or comment, we are not trying to put them down or be polemical. It's just that, it's an opportunity to discuss, because, different people follow different analysts, people say different things. The beauty of having evidence-based approach is that it's not politics, right? It's not opinions. It has to be something is true or is not true. And there are methods, and one can discuss how you go about improving these, one can have a debate, but in the end, it has to be, when somebody makes a claim, it has to be that there is a way of demonstrating if this claim is true or not, right? So anyway, so I saw this video from Sina. Sina is a professional. He's a PhD in his field. He's, business. He's more focused on business. and it teaches some econometric classes where the fundamental of data analysis of price action is discussed. My problem with that is that the entire idea of doing research is that you use the book as your foundation, and then you go beyond the book, right? The book, what is in the book was research 10, 15, 20, 30 years ago, and then has been verified and made it to the book. Research is by definition something that is not in the book, and so many times you have to be a little bit open-minded, and you have to be creative to really to do research. So the topic in question in this video, I think several people watch, is that this discussion that it's relevant to many people. Many people are interested in this because it's one of the things that people look at to get some level of comfort or directionality for the price. They want to know what is going to happen next, right? And so is this idea, we already explored it, but so this is kind of revisiting a little bit this topic in particular at the light of these comments from Sina. From what I understood, Sina say things that I have said myself many times about this relationship between global liquidity, in particular this quantity called M2, and the price, right? I started with a generic model of global liquidity versus price. In the beginning, I even resisted that because my approach was I want to look at only Bitcoin, everything internally at Bitcoin. I think Bitcoin determines its own price. You don't need to look at external things. But under pressure, I started to look at M2 or other measure of global liquidity, and it was useful. The first time I ever made a plot of a price versus global liquidity, I didn't see. Of course, I tried everything. I tried if it was an exponential relationship. I tried if it was a power law, and it was if you took the entire history. This is something that me and Stephen also discussed. It doesn't look like a power law. It's more complicated than that. It's so complicated that in fact you have to start to use what is called a Taylor expansion, that means a polynomial model, basically where you add more and more terms. And we already discussed this idea of adding more terms. Once you add more terms, you can fit anything. There is this mathematical theorem called Taylor theorem that basically says if you add more and more polynomial, and these polynomials have higher and higher power, right? You start with a constant, when you add x, when you add a square, x cubed, x4, you can approximate absolutely anything. Every twist and turn. The problem that when you do that, it has zero predictive power because you are basically creating a model of a past. And the entire idea of making a model that applies also to the future is to eliminate the noise and the things that are just local and that they're not going to be repeated, and finding the signal if there is some kind of long-term trajectory. So you want to arrive to that. The beauty of a power law that is exactly doing that is trying to find the signal in the noise. But if you add a more and more term, you're just basically just modeling the noise, and you're losing the signal. So and you can still do it if it is a compromise. That is a compromise. It's something that maybe will work just for a little while. You will have to adjust it over time. So I made basically a polynomial expansion of a relationship between global liquidity and the price. And I posted, I made an article, I wrote an article. Then people started to discuss and this idea that maybe there was a delay, there is some kind of a shift between global liquidity and the price. And for example, this person that actually me, Stephen, Fred actually interviewed, his name is Owl, and he's a kind of old-timer in finance and somebody that knows what he's talking about, and a respected figure. He wrote several books about micro economics. he also stated that there is this shift, and I started to take it more seriously. I looked into it, and actually got convinced that yes, there are two things that I found out. One, if you limit your time frame to 10 years, the relationship between the global liquidity and the price looks like a power law. It's not foundational in the sense that it's not based on something fundamental, because after all, the long-term growth of the global liquidity, it's an exponential, and the long-term trajectory of the coin is a power law. So they cannot be related by a simple relationship, right? It has to be something more complex. But if you look at a short term of it is 10 years, it is still decent amount of time. It's a good approximation to say there is a power law. And it's a crazy power law because the power is 9. That means a small little change in global liquidity creates a huge change in price. So that is one thing. And then, yes, there is a delay, and you can demonstrate that this delay is not, it's basically it's not something that you make up because you're not trying to pattern matching. Like, basically finding Jesus on a tortilla, or looking at the clouds and say, the cloud looks like an elephant, right? That is a risk that you always run in doing any type of data analysis. But I was, whenever I did that complex model, I actually justify, say, look, I think people that say there is a delay, they are basically doing this, they are doing this pattern matching, and it's not real. And then, that is the beauty of actually using math and science, that you can revisit your idea, test more, and then change your mind, because a good analyst should change his mind in front of new evidence, right? And the evidence to me was overwhelming, but there is a delay. Now, some of the things that Sina said in his video, because basically he was dismissing the entire thing. I think he actually didn't go deep. He was just warning people about this matching. And then most of his video was about overfitting, from basically a textbook point of view, without really spending the time in exploring this topic in depth. And some of the things that he say were valid. So I invite everybody to watch his video, because it's a kind of a little lesson about the idea of overfitting. But and it's good advice in general. But if that is the only thing that happens with this relationship between global liquidity and the price, it will be the end of the story. But the story continues, because actually it turns out that there is a relationship, and I have different ways. Like this indicator already shows you. It's one of the things I will show you how I derived. So hold on, I will explain you this, but you can see even visually. So the orange one is actually global liquidity. I'm calculating a quantity that makes it into an oscillator. I will explain this quantity in a moment, but you can see there are obvious correspondences, right? So you can see where the lows are for this quantity, where the top is, and you will not say that these two are not related to each other. And here I'm using a delay. I'm using a delay of 85 days. Same thing here, where you see the difference between the purple and the green line. The purple, the green line is a little bit a smoother version. It's not simply a moving average. It's actually, I do the moving average. I average first price and global liquidity, and then I try to find a relationship between these smoothed versions of global liquidity and price. But the two match pretty well. The other one, the purple one, is just pure global liquidity. One of the things that Sina was saying that is useful is that part of the variability of the global liquidity is also the exchange value between dollars, because to add so M2 in this case is the money circulation from many different countries, and different countries use different currencies, but to sum them together, you need to convert them to one single currency. You can use gold. In theory, you could convert all of them in gold or some other reference, but usually you do it in US dollars. So you basically calculate how much money, how much yen there is, convert it into dollar. And if a exchange rate changes, it creates some of these fluctuations here, right? Plus, the other things he was saying is that some countries report in different times. Some countries report almost weekly, other countries takes months or even a couple of months. Well, that could explain why there is a delay in the first place, or maybe um, you know it's independent of that. It doesn't matter because in the end we don't care why there is this delay. If once it is established and you calculate what is the optimal delay, that is it. Anyway, so one of the things I did was this, right? So I say, because there are a couple of problems. One is this variability. So one of the things I agree with Sina, and I see done by other analysts that is so super silly, is to basically attribute to every, in particular when you zoom in, right, with this quantity. I see certain chart where they say, oh, we are having a local bottom right now. That is because of the global liquidity. It's silly. That is pattern matching. No, it's not every single twists and turns in the global liquidity that determine the price. It's more directional. And the other, so this is one problem. And the other problem is scaling. Like, for example, if you try to match certain, like here, for example, you see how well I'm matching this component, of the price. We seem to be basically on top of each other, but the other one diverge, right? If I stretch and squeeze the global liquidity, I can find ways of actually matching almost every little local pattern. But then I would need to use another amount of stretching and squeezing in the other components, right? So there is some scaling issue. That means that the relationship is not one-to-one. It's more directional. So to avoid this problem at all of scaling, I say, let's look at the direction. So I focus on going up or down. So what are you seeing in this graph? I say, imagine I assign 1 to every time global liquidity goes up, and same thing with the price, and -1 when we go down. So it's basically there are only 2 modes, up or down, and I don't care about how much, right? So only going up and down. And then I calculate, first actually I smooth with, you can use different windows. One that works well is 100 days. So I smooth both and do a moving average of the price. I do a moving average of global liquidity. And then I calculate this quantity, right? Basically, I transform the price and GL in -1 and 1, -1 and 1. And then I calculate how well they correlate with each other. So, for example, these, and why it looks like a cloud, I added some noise, because if you do these over and over again, all the ones will go on top of each other. So you will get only 1 dot here, 1 dot here, 1 dot here. So I'm spreading it a little bit. It's just a visual way of showing how many times the two agree, right? So, and so I to do that, I added some noise. So some data points it's 0.9, some data point is -1. So, but they are all close to each other, basically means 1, right? Is that clear, Stephen?
Yes. So I guess the question is, how much of the weight is in the upper right?
Right. So yeah. So this is about 72%. So the times when they agree with each other, that is in particular up. It's interesting that it's actually not symmetric. They agree more when we go up than when we go down. It's 72 here and about 50 C. It can change. It depends on your smoothing window, but the one that I ended up using when we go down, it's about 56%. So it's beating chance. But this one is very strong, 72% of the time. So you can use this as a predictor, because remember, in fact, what did they do? So you see why this works, right? It works because you can see if it was just chance, if the two were not correlated at all, every bubble will look kind of the same density, right? But this is clearly just by visual inspection. I like to do certain things when I do my exploratory calculations that are like this, where I get intuition from exploring things, right? If I see some clustering there, it's not something I don't know if many people use something like that. I come up with methods that make sense to me sometimes. I like this one because I can see it immediately. Aha, there is something going on there. There is a signal, right? You will not have this, you will not have this stronger bubble, right? The denser bubble if it was not this increase in correlation between the two for this case. It's very clear, right? You can see it with your naked eye. And then what they did, I calculate basically when they agree when both GL and price are 1-1, right? So both they say, GL say, oh, we're going up, and then there is an agreement in price. And because GL is predictive, we can check, right, if that is the case. And so I change the delay from just 10 days all the way to 140 days. And it's kind of a convex curve. This is called the sensitivity curve. So, and it peaks at about 75 days, something like that. And same kind of peak here. This is the other way when you have -1 and -1 when we go down.
So question, how do you build the daily series for M2 for global liquidity? How is that built?
So on TradingView, there are measures of all the different countries and tools. And
how do they get the daily resolution? Are they just interpolating between monthly releases?
I don't know. It's possible that the variability, like Sina was explaining, so they keep the last update, but then there will be some daily variability because the exchange rate changes, right? So your conversion to dollars will change, right? But then there will be a big change like 1 month later, right? When there is a new
that's
or whatever.
That seems sensible. Okay.
Yeah, it's not perfect, right? It's amazing if you have any predictability at all, in particular because it's 70 days ahead of time. So I don't care. Anything that can give me a little bit of advantage in knowing where we are going, it's good enough for me, right? If it is not completely junk, and it's not junk because
could you compute the average win to average loss ratio?
Yeah, exactly. So that is also what they did.
Yeah.
So first of all, here is so for example, with this particular smoothing, it's a very strong smoothing. I think I did 150 days or something like that. Then I did a curve that represents the cumulative sum of these win and losses, right? And you can see again, structurally, the two agree. Now, with some differences, but in general, like for example, here, you see this bump here? That bump is due to the ETFs. The ETFs came along and we create some kind of decoupling between the global liquidity and Bitcoin. But that is what I'm showing here. That is the winning rate. So basically, I'm looking the losing rate will be 1 minus that, right? So we don't have to calculate both. We can calculate the winning rate. For winning rate, I mean when we went up, and then going and calculating the winning rate average over a window. I think I use again 100 day or something like that. And so the red curve is GL, the black curve is Bitcoin. So this is telling us, right, when we have a bubble, the winning rate goes up, right? We have more winning. I should put maybe a reference line at 0.5, but we are going above 0.5 during a bubble. We reach a peak. Now this will be the peak, right? Notice usually the peak for GL happens later. And I think the interpretation of this is that when we have a strong, at least in the past, peak in the price, it's mostly FOMO, right? It decouples from macroeconomics. It's all internal, where people get excited, they push the price up, and it doesn't follow necessarily the liquidity. This is, in fact, the definition of a bubble when you don't have the fundamental behind, right? If a price is basically like a hot vapor, right? Hot steam. You push it, and of course it will collapse because there is no enough liquidity to support this push up. Does it make sense? Is a good interpretation of this idea that BTC and GL will decouple at the top, Stephen?
I think maybe the whales get out early.
Yeah, oh, they will. Maybe that is another interpretation.
They're saying, oh, yeah.
Yeah, that the whale gets up early because they know what is going on.
Because it's not just the GL level, it's the change in GL. So
yeah, exactly.
Yeah.
And this is and this decoupling here again. It's kind of associated with the FOMO. There was a lot of injection of funds and also excitement about the ETF, and so the two decouple. But in general, you can see you cannot say, and this is with this delay of 75. Basically, I use the top here, whatever top value we got here. And by the way, whenever you have data like this, where you have a sensitivity measure that is very, very smooth, and then it has convexity, that means it has a maximum. This is a very good sign. It's one of the things that we do often in data analysis to say, okay, this measure that you're calculating has some signal, because otherwise it will be just all over the place. And in fact, it has a maximum. You can use that maximum as your best, kind of optimal value. It's a kind of an optimization process, right? And so using that optimization value, that ideal delay. Now, it is possible that maybe there is an optimal value for the bottoms, an optimal value for the top, but we are using one that works in general. You cannot say that these two things are not correlated. It's completely obvious that they are correlated. Now, are they correlated at every twist and turns? No, but in general, yes, they are correlated.
That delay is exactly what Michael Howell found. It was 11 weeks. So,
exactly. Yeah.
Yeah.
So it's another way of confirming this. It's a real thing. It's there. So while you can tell people to be careful about matching things, etc., you also have to be careful not to throw away the baby with the water. The conclusion is, like, if you hear people say, oh, look, right now we can explain this bottom because this local bottom because of the global liquidity, that is silly. Don't listen to that. But the general idea that we can use global liquidity as kind of a directional indicator, and it's one of the many things. We want more than one indicator. We want many different things. It's like going to the doctor, and the doctor does X-rays and MRI, etc. We want to look at many different things, and global liquidity is for sure one of the things to look at. And right now, if you're looking at the chart, the graphic I just show, it's not a live chart, but it's the latest update. Right now, we still are going up. Liquidity is still going up. So that is a good sign. It tells us that it is, it should be that we can continue to follow this liquidity at least for the next few weeks. So it's a good sign. I don't think it's necessary, but I don't think it's sufficient, right? In mathematics, we say this condition is sufficient, is necessary and sufficient, right? So necessary means you need to have it for something to be real or true, and sufficient, if you have it, then it is true. In this case, this one is, I will say, it's not necessary maybe, but it's good to have it, right? You need to have you need to kind of have liquidity for a bull run to be sustained. Otherwise, it will collapse. And right now, yes, we have a liquidity. Liquidity is going in the right direction. So that is what we can say about that. We are so it's 9:30. It's more than 1 hour. I want to discuss this topic of scarcity, but we can maybe do it next time, because in the last few days I was having a lot of discussion. I think these were a little bit more positive because I'm improving my communication about this topic of scarcity. I think I'm going to make it the focus of the next episode and focus only on that, and we can discuss it next time. Anyway, so maybe let's focus on the questions now. We have a few. All right. Okay, so we have this question here that says new buys will not care about being a whole coiner anymore, thinking it's all about sats. We will see. I don't know where this comes from, but you have something to say about this idea of, because there are a lot of people say,
Yeah,
oh, it's important to have a one coin, you know.
I think it's our responsibility to educate people. There's just a lack of education about this, or a lack of awareness, and people just look at the price and say, "I can't afford that," and they don't understand that they can afford, some number of, 1 million sats or whatever the number is. So I think as a community, we just need to educate people more on this. And I wish there were kind of well-established denominations, smaller denominations, because sats is too small. So I like the idea of kilosats and megasats and gigasats personally. But
Mm-hmm. Yeah, and I think it could be detrimental because I know, and the people that are still on the fence, they see 100,000, they still think, there are still people think that that is the only way to get a Bitcoin, that you will have to buy an entire Bitcoin, and they think I don't have $100,000 to spend on these, So yeah, I don't know. I'm not, and at the same time, of course, it's a little bit. It's one of these things that has a lot of inertia. Where okay, now let's always talk about Bitcoin price only in terms of sats, right? This we can always do that. That is an option, right? Maybe like in languages, like like in San Diego, right? You find a lot of places where you have both English and Spanish. So maybe can have both, right? Whenever the price is quoted, we should have Bitcoin and then Sats, right? Maybe both of them. That could be at least a temporary solution, and specify that people can buy fractions of Bitcoin all the time, telling everybody about that. Okay, and these other questions about LuxM2 has gone up about 9% in the last 12 months. I didn't calculate that. In general, it looks like, when I fit it the 10 years, the power was 9. And if you went, I just calculate these on the spot. If it is 9% with a power of 9, Bitcoin should have gone up by a factor of 2 in the last 12 months. And I don't think that is the case. So it's possible that right now we are going a little bit slower than the usual relationship between M2 and Bitcoin. But yeah, a small change in liquidity usually means a big change in price. Does that mean M2 will finally kick off between? Look, when we had the bubble, the temporary bubble during November, I already predicted ahead of time because it just happened when usually we do have bubbles in the November of it. I measure usually my way of measuring cycles from top to top. So we usually have 1 year down, when we have 2 year along with power law, and then 1 year up, right? So it's basically in November it was the third year, so it was supposed to be the beginning of a bull run, right? And then we will have 1 year of bull run. I was lamenting all the time that the price was going up and liquidity was going down. At that time, I was not using the this delay, because I will have look at that and say, oh, liquidity is going down. That means price is going down. That is a predictor. That in a few months from now we are going down. And in fact, we went down in February. We started to go down. So now we are going up again. So that is good. Now it's just one more sign. There are many signs that say the cycle is not over. We had some anomalies during February, until April. We are back above a power law trend, and it's possible that we will continue to have a bubble like we had it before. And in fact, we even reached 200K. That is what I predicted. And Stephen has done similar prediction that Stephen calculated at least in 3 or 4 different ways. And you always end up to similar values to the one I calculated, because that is the truth. Like if everything happens like before, we are going to reach kind of that value. It's not excluded yet, right? I mean, for if we were in October and November, yes, because we will have 1 month and Bitcoin doesn't jump by 2 in few weeks, in particular now. But we still have 5-6 months, so it's possible, So we will see. Okay. Do you both have an opinion for when BTC top will be? Does this model have an opinion?
This approximate entropy model does not have an opinion. It showed, the existence of a mini bubble that peaked in December of last year, and it had the, precursor warning for that. And so that was consistent, but it hasn't given another signal. So you have to look to other models to get an opinion. This, I don't know if you can see it, but this is the chart from the log periodic power law model. And it says that we're kind of in a critical time. If we want to get, there's a lot of glare on the screen, but we need to get through this next little bubble if we're going to stay on that model. And that bubble
Do you have an update? Do you have an update of that? That will be cool.
No, I'm going to go back and I need to do an update of that. And maybe for next week I'll show it. But we need to have some bubble going on in the June-July timeframe to stay on that particular sequence. And we would want to get up to 120,000. So that would be confirmatory. We've got the liquidity backdrop. Maybe we've got the geopolitical backdrop. I think we've got the fiscal backdrop. So we will see.
Right. Yeah. So it's not quite a matter of opinion. If the way to think about this correctly is this, right? I say all the time, the power law that is the backbone of what me and Stephen do when we analyze the Bitcoin behavior says one thing. We call in physics, we have all this order of approximation. There is this order that is called the zeroth order. That means the most basic thing that you can discuss about a phenomenon, right? Before anything else, with zeroth order. Then you have zeroth order approximation. Then you have first order approximation, second order approximation. So the zero order, that is the power law, says which bubble are you talking about? There are no bubble, because the entire idea is that if you have the reason why you have a power law over a long period of time is that the bubbles cancel. We go up as much as we go down, and we always go back to this power law support. So they cancel out. It's almost like they didn't exist. In fact, you can take an average over 4-year period, and it looks exactly like a power law. The moving average looks like with a slight bump because of a bump. The bubbles are not completely canceled, but 4 years is the right amount because the cycle are 4 years long. They basically look like it approximates the power law. In fact, it looks like a little snake that is oscillating around the power law. It's really interesting. But this first order approximation, when you say, okay, well, after all, these bubbles exist. And so then you can start to study them. And the best way to study them is actually to use the power law, because the power law is a reference. Stephen has done many studies where he revisit other techniques that people use to study Bitcoin. But the problem with these techniques that they never use the power law as a reference. You're coming up with wrong conclusion because they don't include that trend. Or exclude. Sometimes you can simply say, okay, let's exclude it first because that is the basic behavior, and then you see what is left over. And this is how you study the bubble using the power law. It's not the power law per se doesn't say anything about the bubbles, but you can study better the bubbles by taking out first the long-term trajectory, and then say everything else that is left over are the bubbles, and then now you study them in a more relevant way. And then you see many patterns. You see periodicities in these bubbles. You see a decay of the peaks. But even that is predictable and follows a mathematical pattern. And you can do it in many different ways. And then the idea is, if this is what I say all the time, if the patterns persist and is going to be repeated this cycle, that is a big if, then this is what to expect. And it's not a guarantee. At the same time, one of the reasons why we do models is because even when models do not work, you can compare what it should have happened with what is happening. So it's a way of actually knowing that something is different. If you didn't have a model, you will not be able to do that. So this is the different way that you understand this topic. And if everything follow the pattern, we expect two things. One, the bubble will have a peak at the end of the year. That could be anything between, there is always some uncertainty in these things. It's never perfect. It can be anything between October to December. Usually, historically, we never had a bubble after the end of the year. It's always before the end of the year. But it can oscillate anything between October to December. And the other thing, the bubble will be about, the reason why is 200 is because power law alone tell us 130 by the end of the year. And every calculation we do using different methods converge at about something like 2 per the deviation. So anything between 200 to 250, something like that. My calculation using the decay of the bubble is 80%. And compare with the first deviations when we had the first bubble, some of the first bubbles had like 10 pair deviations, right? That will be the same. Imagine we had one bubble like that right now. That will mean that we will go to 1,000,000 point something. But that is, when Bitcoin was a baby, when it was much smaller, and then it could do that. And now we have $2 trillion market cap. It's much more difficult to get factor of 2, 3, 5, 10, almost impossible. So this is the way to think about that. All right. Okay. You say the presentation was a bit dodgy for me. Thanks for your side. Okay.
Yeah, no worries, Owen. It's kind of a doozy for me too. I'm new to it. But I think what it does is it shows clearly the difference between the core and the power law core and bubbles. And, without worrying about the details of how one calculates it, it seems to have predictive value because, for a couple of the series, 2 of them both have their peaks preceding the peak in the bubbles. So I think that's really the only takeaway we need.
What do you think about this?
I think it's a great idea. I think it's a great idea.
Yeah. I mean, it will be interesting if more companies, in fact, organizations, right, different maybe endowments, different universities, etc. For sure, the Bitcoin Research Institute will accept donations in Bitcoin, for sure.
We need to have the conversation, Giovanni. We haven't had it yet, but I think our treasury needs to be a Bitcoin-centric treasury, right?
Absolutely. Yeah. In fact, it could be an example of this, right? Having non-profits organization that do the same thing, because, look, Bitcoin, if you are a Bitcoiner and you could be considered crazy, and say that so far, everybody that call us crazy showed up to be they are the crazy ones. We are the right ones. And it's something that has lasted for 16 years. I think it's going to last for other 20 or more. But, if we are right, basically the idea is that all the wealth of the world is being transferred to Bitcoin. So that is a sure bet, right? You want to do this, and that is, it's almost a survival thing. It's not even an investment. It's a survival thing. And I know our vision can look fanatic, it can look strange, if you look at that way outside. But you know what? After being in Bitcoin for 12 years, to me, everything else looks strange and crazy. How people think about money, investment. Every time I talk with people, and they talk with a lot of people, they look like crazy ones. So I think everybody should start to move in this direction. Now, another thing, though, and this is another thing that I discuss often, there are more than one way to use Bitcoin volatility, right? So, for example, you can learn about doing things like options, like maybe maybe learn how to do cover call, for example. Have you ever played with the cover calls yourself?
Yes.
Yeah, you can do cover
Many times.
calls, right? Because again, these tools that we are developing could be used for that. If you are understanding where we are in terms of volatility, in terms of entropy, maybe there are applications for these tools to actually decide, okay, with the cover call. In fact, one day maybe we can actually talk about that. How do we go from the science to engineering? Not because we are trying to say go and trade, but do it with a small amount. Like, for example, I learned how to do options using Robinhood with a few $100, just so I learned something new, a new skill, a new idea. And then if it works for you, and maybe you can build on that. Because the beauty of Bitcoin, it has two properties. It's still very volatile. And like Stephen says all the time, it has the right volatility. It's skewed to the right. That means it's a good volatility for you, because usually it's bigger gains than losses. And also it has a long-term trajectory, right? And if you combine these two things, you have one of the best assets ever on earth, right? So that is the entire idea. I don't know if you want to add anything to that.
Yeah, that's good. Yeah.
Okay, and Marcus talk about so Marcus is, I don't know if you know him, but I do this show with the guys from Minotaur, and he's an expert in what is called local liquidity. So he looks at the liquidity inherent in Bitcoin itself. That is another topic that we could explore more scientifically. But yeah, they are complementary, but they are really also two different things. So he's mostly focused on local liquidity. Okay, and then maybe this could be the last question for now. Yeah. What about this?
Yeah. Well, the network integrity would have to break. And so, what are the things that could destabilize the network integrity and could maybe flatten the power law, slow adoption rate, and so forth?
Yeah.
One
answer to that is it happened. And in fact, it happened 4 times. Right. So every single bubble is an attempt to break away from the power law. And you know what happened?
Well, that's not a breakdown, though. That's a breakup. So I think the global issue is would it break down?
No, I get it, but I'm trying to be a little bit facetious here, right? And trying to say, because it's also an interesting point, right? You can think that every time you have this crazy behavior, right, where we have these crazy bubbles, we go like that and so on, it's a challenge to the power law. We leave a power law behind. And and we do it for 1 year going up. And so it's quite a large amount of time where we are challenging the power law. And what is the result of that? The result is that Bitcoin wants to go back to the power law. And so, I'm saying this because I think even if it happens, and it already happened, unless you're saying, well, but this time is not coming back, right? Well, I don't think that is possible. This is what I'm trying to say.
The bubbles don't break it. So it would have to be something that's more integral to the network structure and the narrative.
Yeah, but that is one way of seeing it, right? The other way of saying is why they don't break it, because it's not possible to break it. We tried 4 times and we failed, right? Or whatever, the world tried 4 times.
I think the biggest challenges, though, were not the bubbles. I think the biggest challenges were the fork wars in 2017, and then all of the issues around regulation or trying to restrict mining, whether it was the Chinese clampdown on mining or whether it was restrictive regulation by various governments around the world. It survived all those because those were things that could have broken the overall network belief and structure and narrative. So if you had we've relied on the fact that it's been very conservative approach to changing the code, right? That we have only a few of these Bitcoin improvement proposals, and that the process is kind of stable and lengthy and requires a lot of consensus. You don't have committees, or you don't have one guy, who's running around making decisions for the whole network. It's done by consensus. And also the network has evolved a complex structure with a lot of rich hubs. And it turns out that the hub and spoke model implies more strength for the network, more power law behavior and higher power law indices. And this is something that's not fully realized. So I think the way it's evolved, the topology of it, has shown that it's got that persistence and strength.
Yeah, exactly. So, and also look, it's always difficult to describe the unknown, right? We always go from the known to the unknown, and we don't have much to say. Besides, like this is why I mentioned again the bubbles, as that is the closest that we come to challenge the power law. But then the result was that somehow it corrected itself. But also all these other things that Stephen is mentioning, Bitcoin has been challenged over and over and over again. And in the end, it followed this very organized pattern when you look at the long-term trajectory. And the people that dismiss it as a pattern, as some line, etc., they don't understand what we are discussing. It's this organizing behavior over many order of magnitude that follows a very precise regularity. So it's a law. It's a real law. It's a scaling law. So there is something fundamental about how Bitcoin behaves, organizes itself. It finds, it does price discovery. It reacts to bad news like COVID. COVID was another challenge, right? During COVID, we went all the way. COVID is this little V here. That V went all the way down to the support. It is also another power law, in fact, the strongest power law we have, and bounce back, from that. So there are many situations like that, and so it's very difficult to say what will happen. In the end, I think Bitcoin is Bitcoin, and I believe in the wisdom of Bitcoin as a system. There is, see, one of the things I say that I started to emphasize more and more, one way of understanding what is fundamental about networks is that the whole is bigger than the sum of the parts. That is the beauty of network. We will not have a body where many cells organize themselves if you didn't get something out of that, right? Cells decided, look, I'm going to put away my individuality. I'm going to focus on one particular task, like, being the liver, being the stomach, or whatever, because by working together, we get much more than just the sum of the parts. And that is what Bitcoin is. It's something that is bigger as a whole than the sum of its parts.
The body is a meta network, right? It's a bunch of networks collectively working together, and Bitcoin is a meta network.
Exactly. So and this thing should be celebrated and accepted by more and more people understood it. But as Stephen say, 1% of the world population understands Bitcoin, and 1% understands the power law. And then maybe 1% of that understands the finer points, right? We have two modes and all that kind of stuff. And you guys, by being with us here, are in that little 1% of 1% of 1%.
That's 1 in a million, guys. So pat yourself on the back.
Great. All right. Thank you so much. Thank you, Owen, in particular, because you ask a lot of very good questions. Thank you so much. And we will see you next week. Thank you. Bye.
Thank you. Thanks all.